As a real estate owner, there are two main types of housing-related taxes that you are responsible for: property taxes, also known as real estate taxes, and capital gains taxes. Property taxes are taxes that are collected by your local government to fund services and projects that benefit your community, such as emergency services, libraries, schools, and roads. You pay these taxes directly to your local tax assessor annually or as part of your monthly mortgage payment. Property taxes are calculated based on the assessed value of your land and any structures on it. According to estimates, a significant percentage of properties in the United States, 30% to 60%, are overassessed. If you believe that the tax assessor has made an error in assessing the value of your property, you have the option to appeal the assessed value. Furthermore, you may be eligible for tax deductions and exemptions by taking advantage of various programs, such as those offered to seniors, veterans and their surviving spouses, individuals with disabilities, and agricultural landowners. Additionally, most states provide homestead tax breaks that exclude a portion of your property's value from property taxes. Another option available to you is to check with your local tax office to see if there are any discounts available if you pay your tax bill early. It's advisable to research any tax deductions, exemptions, and discounts that are applicable to your area to minimize your tax burden. In addition to property taxes, homeowners and investors may also be subject to capital gains tax if they sell their property for more than the cost basis. The cost basis is determined by adding the purchase price of the property to any costs associated with buying it, such as mortgage application fees and appraisal fees, as well as the cost of any major improvements made to the property, such as replacing the roof or adding a bathroom. Homeowners may be able to exclude up to $250,000, $500,000 for married couples filing jointly, of capital gains from the sale of their primary home, subject to certain conditions. The home must have been used as your primary residence. You must have lived in the home for at least 2 of the last 5 years, not necessarily consecutive years. You must have owned the home for at least 2 of the last 5 years. Additionally, you may be eligible to exclude some of the gains from the sale of your home due to reasons such as job relocation, medical or health reasons, or an unforeseen circumstance such as death, divorce, or a natural disaster that results in your inability to continue owning your current home. If you have gains from the sale of your property that exceed the exclusion or you are not eligible for it, you will need to report the gain on Schedule D, Form 1040, Capital Gains and Losses. The tax rates that apply depend on how long you have owned the property. If you own the property for less than a year, the gain is considered short-term and is taxed as ordinary income. If you own the property for more than a year, the gain is considered long-term and usually receives a more favorable tax rate. In addition, higher income taxpayers may owe a 3.8% net investment income tax on their capital gains. In addition to the SALT deduction and mortgage interest deduction, there are a few other deductions that homeowners may be eligible for. Home office deduction, home equity loan interest deduction, energy efficient home improvement deduction, eligible for. If you use a portion of your home exclusively for business purposes, you may be able to deduct expenses related to that portion, such as a percentage of your mortgage interest, property taxes, insurance, and utilities. You can deduct the interest you pay on a home equity loan or line of credit, HELOC, if the loan was used to buy, build, or substantially improve your home, up to a limit of $750,000, $375,000 if married filing separately. Real estate investors can also take advantage of a 1031 exchange, which allows them to defer paying capital gains taxes on the sale of an investment property if they reinvest the proceeds in another investment property of equal or greater value. Certain rules apply to execute a 1031 properly, such as abiding by the specific timing limits on identifying and closing of a property. Finally, real estate professionals who meet certain criteria can qualify for special tax treatment, including the ability to deduct losses from their rental properties against their other income. To qualify, you must spend more than half of your working hours and at least 750 hours per year materially participating in real estate activities. According to the IRS, you can depreciate a rental property if it meets 4 conditions. You own the property. You use it in your business or income-producing activity. The property has a determinable useful life. It must be something that wears out, decays, gets used up, becomes obsolete, or loses its value from natural causes. The property is expected to last at least 1 year. The depreciation period for any rental property put into service today is 27.5 years. This means that the cost basis is spread out evenly over this period at a rate of 3.636% each year. You can continue to depreciate the property until you retire it from service or until the end of the 27.5-year period, whichever comes first. To calculate depreciation, you'll need to know the cost of the property, excluding land, the value of the land, and the estimated useful life of the property. You can then deduct a portion of the cost of the property each year for the duration of its useful life. It's important to note that if you sell the property for more than its depreciated value, you may owe a depreciation recapture tax. Depreciation recapture is the process by which the IRS recaptures some of the money from the depreciation deductions you took during ownership. It's based on your ordinary income tax rate and is capped at 25%. This tax applies only to the portion of the gain that can be attributed to the depreciation deductions you already took. You'll use Form 4797, Sales of Business Property, to report depreciation recapture. If you sell an investment property for a loss, depreciation recapture doesn't apply. As long as you owned the property for at least a year, the loss is considered a Section 1231 loss, which you can use to offset your tax liability during the tax year. You can also carry back the loss to offset the previous 2 years' taxable income or carry it forward to offset future income for up to 20 years. Qualified business income, QBI, deduction, which enables pass-through entities to deduct the lesser amount of either 20% of qualified business income plus 20% of qualified REIT dividends and qualified PTP income or 20% of taxable income minus net capital gain. Although many businesses easily meet the criteria for this deduction, determining whether it applies to rental real estate activities has been challenging. The eligibility of rental real estate activities depends on whether they are considered a trade or business. IRS Notice 2019-2007 established a safe harbor for rental real estate, allowing rental property owners to take advantage of the deduction. To be eligible, you must spend at least 250 hours annually managing the property and keep records of your activities. Vacation rentals and triple net leases are not eligible for this deduction. Real estate investment trusts, REITs, provide another investment option in the real estate market. As a REIT owner, you'll receive a $1,099 DIV each year. REIT dividends are categorized into 3 types. Ordinary income dividends, listed in Box 1, are generally taxed at your ordinary income tax rate. Capital gains distributions, listed in Box 2A, are typically taxed as long-term gains, regardless of how long your money was invested in the REIT. Return of capital payments, listed in Box 3, are considered a return of your capital and are not subject to taxation. Qualified Opportunity Funds, QOFs, provide 3 tax benefits. Capital gains deferral. If you invest capital gains in a QOF, you can defer taxes on those gains until the QOF is sold or exchanged, or until December 31st, 2026, whichever comes first. Capital gains reduction. If you hold the capital gains in a QOF for at least 5 years, your basis in the original investment increases by 10%. This increases to 15% if you hold the investment for at least 7 years. Capital gains exclusion. If you hold the QOF for at least 10 years, capital gains generated from the investment are tax-free. At Bangerter Financial, we consider ourselves tax professionals with over 40 years of experience offering our knowledge and services to high-net-worth clients. Join us for live webinars, give us a call or browse our library of PDFs, videos, and content. These are not all the possible tax credits and deductions available. If you would like to discuss your options for tax credits and deductions, reach out to us. 916-965-1879. Also check out our resources page at bangerterfinancial.com/resources. For more educational materials on tax planning, 1031 exchanges, investing and financial planning. Because investor situations and objectives vary, this information is not intended to indicate suitability or a recommendation for any individual investor. This is for informational purposes only, does not constitute individual investment advice, and should not be relied upon as tax or legal advice. Please consult the appropriate professional regarding your individual circumstance. The data contained in this material was obtained from third-party sources believed to be reliable. However, Bangerter Financial and CIS do not guarantee the accuracy of the information. Past performance is not a guarantee of future results. Forecasts and projections are inherently limited and should not be relied upon as an indicator of future results. There are material risks associated with investing in real estate securities, including illiquidity, general market conditions, interest rate risks, financing risks, potentially adverse tax consequences, general economic risks, development risks, and potential loss of the entire investment principal. Investment advisory services offered through Bangerter Financial Services Incorporated, a state-registered investment advisor. Securities offered through Concord Investment Services, LLC. CIS, member FINRA/SIPC. Bangerter Financial Services Incorporated is independent of CIS.